My employees, my shareholders, creditors, clients have taken a huge amount of pain. I wake up every single night thinking, what could I have done differently? This is a pain that will stay with me for the rest of my life.
Imagine standing in the heart of Wall Street, where Lehman Brothers, one of the oldest and most prestigious banks, towers over the financial world. But what if this giant collapsed overnight, triggering a global financial meltdown? What really caused this downfall? Let's find out. So, what exactly was Lehman Brothers? Well, to understand why its collapse was so significant, we first need to know that Lehman was no small player. Founded way back in 1847, Lehman Brothers grew from a humble cotton trading business into one of the largest and most powerful investment banks in the United States. By 2008, it was the fourth largest investment bank in the country. Picture Lehman Brothers like a massive century-old tree, its roots deep in the ground of Wall Street, providing financial services in nearly every corner of the economy. Over the years, Lehman became a major player in the mortgage-backed security and risky investments. But here's the twist, those very investments that once brought it success would be ones that led to its downfall. Irony, right? So, what went wrong? The short answer: risky bets, excessive borrowing, and toxic investments. But let's break it down. In the early 2000s, a big housing boom hit the US, fueled by something called subprime mortgages. Sounds complicated, right? Let me explain. Imagine lending money to people who probably won't be able to pay it back. Sounds risky? Well, that's exactly what banks are doing. Subprime loans were basically risk loans made to borrow with bad credit, and Lehman Brothers, like many other banks, jumped on this bandwagon, thinking housing prices would keep going up. Spoiler alert, they didn't. And here's where things got even messier. Lehman didn't just hold onto these risky loans, they bundled them into mortgage-backed security, MBS, and sold them to investors. It's kind of like trying to sell a broken down car as if it's in perfect condition, except you're doing it at a massive scale with billions of dollars. Over time, Lehman's exposure to these toxic assets grew, and when the housing market began to crumble in 2007, Lehman was sitting in a ticking time bomb. So, how did it all go down? Let's go back to 2007, when the warning signs first started to appear. As housing prices started to decline, people began defaulting on their mortgages. This set off a chain reaction. Lehman's mortgage-backed securities, which had been generating huge profits, started losing value rapidly. The tipping point came in early 2008 when Bear Stearns, another big Wall Street bank, nearly collapsed due to similar bad bets on mortgages. The US government bailed them out, but the panic was spreading, and investors started losing faith in the entire financial system. Lehman Brothers was especially vulnerable because of something called leverage. Basically, the firm had to borrow way too much money to invest in these risky assets. When the value of those assets began to drop, Lehman had no way to pay back its massive debts. Fast forward to September 2008, CEO Richard Fuld was scrambling to find buyers of the company. He tried to get help from Bank of America and Barclays, but when both deals fell through, Lehman had no choice but to file for bankruptcy on September 15, 2008. It was the largest bankruptcy in US history. $613 billion in debt. Can you imagine that? Now you might be wondering, did anyone see this coming? Surprisingly, yes. There were warning signs as early as 2006 when some analysts and insiders started noticing that the housing market was shaky. Lehman's risky investment in subprime mortgages were like a house of cards waiting to collapse. But here's the thing, many of the banks and rating agencies turned a blind eye. Why? Well, as long as profits were rolling in, no one wanted to acknowledge the risks. It's kind of like knowing there's a leak in a boat but hoping you'll reach shore before it sinks. Credit rating agencies, the folks who were supposed to warn investors about risk, kept giving Lehman's asset high ratings even though the foundation of those assets was crumbling. Talk about playing with fire. Lehman Brothers collapsed like dropping a boulder into a still pond. The ripple effect was massive and global. It didn't just affect Wall Street, it triggered a worldwide financial crisis. Banks stopped lending to each other, credit markets froze, and panic spread across financial markets from New York to London to Tokyo. In the US, it sparked a severe recession, with billions of people losing their jobs, homes, and retirement savings. In Europe and Asia, major financial institutions were also shaken. The governments had to step in with bailout to prevent more collapses. It's safe to say that no part of the global economy was left untouched by Lehman's downfall. The sheer scope of Lehman's collapse caused governments to rethink how financial institutions were regulated and how future crises could be prevented. Around the world, new laws were enacted to prevent such reckless practices, and major banks were forced to undergo stress tests to ensure they could survive economic downturns. The collapse also exposed the complex, interconnected nature of global finance, where a crisis in one part of the system could quickly spread and engulf other regions. While some argue that these reforms made the system more stable, others worry that similar risks are still lurking beneath the surface. So, who's to blame for all this? was it Lehman CEO Richard Fuld who earned the nickname Gorilla on Wall Street of his aggressive leadership? Fuld was certainly a key figure, refusing to sell Lehman or merge it with another bank when things were going downhill. Some argue his pride and determination to keep Lehman independent played a huge role in its collapse. But it wasn't just Fuld. The US government and the Federal Reserve also had a hand in it. When Lehman Brothers was on the brink, they chose not to step in and save it like they did with Bear Stearns and AIG. Why? That's a question that'll still spark debate today. Some say the government wanted to send a message that no bank is too big to fail, while others argued that letting Lehman collapse made the crisis much worse. Lehman's collapse didn't happen in a vacuum. It was a symptom of a much bigger problem, what we now call the 2008 global financial crisis. The crisis was driven by a combination of factors: risky mortgage lending, the regulation that allowed banks to take bigger risks, and the housing bubble that finally burst. Lehman's fall was like the first domino, setting off a chain reaction that led to a global financial meltdown. Banks across the world were suddenly struck with billions of dollars in toxic assets, and governments had to step in with massive bailouts to prevent the entire financial system from collapsing. This is where the term "too big to fail" became popular. Some banks, it seems, were so large and interconnected that their failure could take down the entire economy. But wait, there's more. Lehman's collapse also exposed deeper systematic issues within the financial system. One of those issues was a moral hazard. Basically, some banks took bigger risks because they believed that if things went south, the government would bail them out. And for many banks, that is exactly what happened. Lehman, however, was the exception, and its failure sent a shockwave through the banking world. Another issue was the regulation. Over the years, laws like Gramm-Leach-Bliley Act weakened the rules that kept banks in check, allowing them to engage in riskier activities like betting big on mortgage-backed securities. Now, let's clear up a few common misconceptions. First, some people think Lehman's collapse happened overnight. The reality? The warning signs were there for months, if not years, before the company went under. Another myth is that Lehman Brothers was bailed out. Actually, it was one of the few major banks that wasn't rescued by the government, which is why its bankruptcy had such a huge impact. And here's the big one. Some believe Lehman's collapse caused a financial crisis. The truth is, Lehman was just one part of a much larger problem. The global financial system was already unstable, and Lehman's fall simply brought that instability to a surface. So, what do we learn from all this? One of the biggest takeaways was the need for more regulations. In the US, the Dodd-Frank Act was passed to prevent another financial crisis by increasing oversight on banks and requiring them to hold more capital to cover their risks. We also learned that banks need to manage risk better. Lehman's collapse showed that reckless risk-taking can have devastating consequences, not just for banks themselves, but for the entire global economy. Finally, we learned that trust in a financial system is fragile. Once it's broken, it's incredibly hard to rebuild, and the ripple effects can last for years. People lost faith in the markets, and it took significant government intervention and years of recovery efforts to restore that confidence. If you found this deep dive into the collapse of Lehman Brothers insightful, make sure to hit the like button and subscribe for more content breaking down the big events in finance and history. Got any thoughts or questions? Drop them in the comments below, and let's keep the conversation going. Thanks for watching, and we'll see you in the next video.